Welcome to the latest edition of our Fixed Interests podcast series. I'm Thomas Rookmaaker, head of Asia Pacific Sovereign Ratings. Today I'm joined by Jeremy Zook, a director in Fitch's Sovereign team and lead analyst for India. We'll be discussing the outlook for India's economic policies and its BBB- rating with a stable outlook. So Jeremy, let's start with the central government's budget, which was presented at the beginning of last month. Could you give a brief overview of the key elements of the budget?
Sure, Thomas. So in this budget, the central government continued with its focus on maintaining macro stability through its path of gradual fiscal consolidation, which was largely in line with our previous expectations. So for the current fiscal year 25, which ends at the end of March 2025, the government is estimating the deficit to be 4.8% of GDP. And for next fiscal year, FY26, the government is targeting a deficit of 4.4% of GDP. So this means that the government is likely to achieve its medium-term deficit target for FY26, which it set for itself several years ago at 4.5% of GDP. And this helps to essentially enhance the government's fiscal credibility. Still, growth is moderating from its highs of the past several years, and the trade-offs between deficit reduction and economic growth objectives are becoming a bit more challenging. So that one of the key focuses of this year's budget was trying to boost consumption through tax cuts to the middle class. The government also sustained its focus on infrastructure spending, which is slated to remain stable at 3.1% of GDP. And then finally, the government outlined a new fiscal strategy, which shifts to a debt target of 50% of GDP plus or minus 1% by FY31.
This year's budget has come at a more challenging juncture for India's economy. First, how does Fitch see India's near-term growth outlook? And second, how will the current fiscal and monetary policy mix likely impact this economic outlook?
GDP growth has certainly slowed in the current fiscal year, but we see this more as a temporary soft patch rather than a prolonged slowdown in economic activity. Indeed, the recently published GDP numbers that came out at the end of February for the third quarter of fiscal year 25 showed that growth recovered to 6.2% year over year from 5.4% in the previous quarter. During the first half of this fiscal year, it seems that the root cause of the slowdown was really driven by delays in government CapEx spending that came about as a result of the elections that were held in April and May of 2024. An additional factor is that we haven't really seen a meaningful acceleration in manufacturing investment. Construction activity has been relatively robust, but on the manufacturing side, I think we have yet to see that really pick up. And then finally, consumption has also been a bit subdued. Spending by urban households has become a bit more restrained. I think part of that is perhaps a regulatory tightening around consumer credit by the RBI. But, we expect growth to continue to pick up and hold relatively firm in the coming year. We forecast growth in FY25 to come in at 6.4%, and for that to tick up slightly to 6.5% in fiscal year 26. Private consumption did pick up in the last quarter, and we expect it to remain relatively resilient over the next year. We also expect public CapEx to reaccelerate after the election-driven slowdown, and both of those things should help to support the outlook. There are still, of course, challenges. We expect private investment to pick up steadily, but I think there are some key risks that the high level of trade and geopolitical uncertainty at the moment could lead to dampened investor sentiment and push off investment intentions. And that could be compounded if domestic consumption kind of underperforms our expectations. Now, the policy stance we think is somewhat mixed, but it's broadly neutral at this stage. The fiscal policy, given just the ongoing reduction in the overall deficit, is slightly contractionary, but the composition of budget measures, again, that focus on CapEx spending and the tax cuts for households that have a relatively high propensity to consume, should help to mitigate some of the negative impulse from that overall deficit reduction. Monetary policy is also easing. The RBI cut its policy rate in February by 25 basis points to 6.25% in its first meeting with the new governor. Core inflation is still relatively contained, just below the 4% midpoint of the RBI's 2 to 6% target band, which will give the RBI scope to cut rates amid slowing growth. That said, headline inflation remains relatively volatile and towards the upper end of the target band, and there has been more pressure for rupee depreciation against the US dollar, which could constrain the RBI's ability or desire to ease policy significantly.
Now, as a brief aside on the growth and external front, there has been a steady drumbeat of announcements on tariff increases by the new US administration. So how is this likely to impact India's growth? And relatedly, how does Fitch see India's external position more broadly in current context?
So there have not been any direct tariffs implemented on India as of yet, but there are signs that U.S. tariffs on India's exports could be coming. The new U.S. administration under President Donald Trump has announced its plans for so-called reciprocal tariffs, which would be applied on a global basis. The exact parameters of what reciprocal tariffs will look like are set to come in early April. The U.S. is likely to implement tariffs to match the tariffs imposed by other economies, and India has relatively high rates of tariffs as well as value-added taxes, which may also be included in this reciprocal tariff arrangement. India's already reduced some of these tariff rates ahead of a visit by Prime Minister Modi to meet President Trump. And so they are trying to manage kind of the expectations on the tariff front. The direct impact on India's economy would be probably somewhat modest. Exports aren't a huge growth driver for India, and direct exports to the U.S. account for just 2.3% of GDP. But again, the overall trade uncertainty would still likely have negative sentiment spillovers to India. On the exchange rate, we have seen more pressure on the rupee against the US dollar. Over the past couple years, the RBI has intervened to keep the rupee relatively range bound. But we have seen a bit of a shift. Since last October, the rupee has depreciated over 3.5% against the US dollar. FX reserves have fallen from just over 700 million US dollars to around 640 million as the RBI leaned against some depreciation pressures initially. But the new RBI government seems to be shifting FX policy a bit, allowing some slightly more flexibility, and this has allowed reserves to recover a bit over the past few weeks. Overall, though, India's external position remains sound and a bit of a rating strength. FX reserves are still adequate, and the current account deficit is well contained.
So, Jeremy, you mentioned earlier that the government outlined a new medium-term fiscal strategy in the budget. Could you take us through the key elements of this new strategy, and how does it change our assessment of the government's fiscal credibility over the medium term?
So just by brief background, in 2003, the government implemented the Fiscal Responsibility and Budget Management Act, which focused on anchoring India's fiscal policy with a 3% of GDP deficit target for the central government and a 3% of GDP target for state governments, 6% from a general government perspective, along with a essentially debt ceiling of 60% of GDP, again, on a general government basis. Now, the government has never really been able to achieve the target set out under the FRBM Act. And so one of the policies put forward in this budget was formulating a new medium-term and more credible fiscal strategy. So the government has proposed now putting debt on a downward trend towards a central government debt level of 50% of GDP plus or minus 1% by fiscal year 31. This would essentially be about a 7 percentage point decline in the current central government debt ratio. Now, there's a few questions I think still around this fiscal rule. So first of all, what does this mean for the deficit path? If we think about the deficit in FY26, 4.4% of GDP, It would essentially mean keeping the deficit at or just below those levels over the next 5 years. Also, we have to think about the growth sensitivity of debt dynamics. If growth slips below kind of a double-digit level, that will make achieving this downward trend in the debt ratio more challenging. Also, we have not just the central government, but we have state governments as well. So thinking about the debt trajectory of general government debt is also something that we consider. Now, I think overall, though, we do view this fiscal strategy as relatively credible. The medium-term targets are broadly in line with what we expected when we did our last review in August. So from that perspective, we do find these new fiscal strategy credible.
Let's end by turning to the sovereign rating. So what are the implications for India's sovereign rating of the economic, fiscal, and external dynamics that we've just discussed? What are the key factors for the rating in either the positive or negative direction?
When we think about fiscal policy in particular, we have seen quite an improvement in fiscal credibility as well as transparency. So the government has been able to achieve or outperform its fiscal deficit targets over the past several years. It's brought a lot of off-budget spending onto its balance sheet directly. And so this helps us to monitor fiscal activity more easily. That said, the pace of fiscal consolidation has been relatively gradual. And when we look at India's structural fiscal metrics compared to peers, they are still relatively weak. Next year, we're forecasting a general government deficit of about 7.2% of GDP, about twice the level of the BBB peer median. General government debt is just around 82% of GDP compared to a BBB median of just in the high 50% of GDP range. And interest to revenue is about 25%. That's over twice the level of the BBB peer median. So addressing those structural fiscal metrics will depend on kind of maintaining this improved credibility on the fiscal front, as well as the sustaining relatively robust rates of economic growth, as we've discussed. So really, I think, that's kind of the key factor for the rating going forward is what happens certainly on towards the positive side in terms of bringing down the government debt ratio and improving this record of fiscal credibility, giving us more confidence that government debt can continue to trend downwards. Likewise, on kind of the negative side, given that India's debt is still relatively high, if we were to see an economic shock that pushes the government debt ratio much higher because deficits rise sharply, that would be certainly a potential downside trigger for the sovereign rating.
Thanks for your insights, Jeremy, and thank you all for listening. For more information on our ratings and on our research on India, please visit us at fitchratings.com. We hope you will join us for the next edition of Fixed Interests.